Hey everyone, welcome to the Homebuying Secrets podcast. This is episode one, and I am joined by some real estate experts here with lots of secrets to share with you, Frank and Jason. Frank, could you introduce yourself?
Hi, good morning. I'm Frank Magdaleno. Howdy. Been in real estate for almost 20 years in Orange County, all over SoCal. Work with home buyers and home sellers, looking to help people out.
Awesome. Jason?
What's going on, everybody? I am Jason DeCicciolo. I am a mortgage broker here in Southern California, helping people buy homes and refinance them as well.
So, the three of us started this show because we have lots of friends, colleagues, families who, work in big tech firms or maybe dabble a little bit in crypto. And, it's been a great couple of years to be an investor. And if you are an investor in crypto or the stock market, you're doing super well. And, our opinion is you should take a little bit of your gains off the top and invest in your first home if you haven't yet, and maybe explore investing in additional properties if you already own your home as well. Today, we really want to just cover the entire end-to-end process, the high-level process of what it takes to buy your first home. And then in future episodes, we'll cover each step in more details. So let's start off with you, Jason. So what's the first thing people need to think about before they even get like a pre-approval? Is it like saving years of money? Like what do people think about?
I think even before people really start trying to save money and coming up with that plan, I honestly think they should reach out to a mortgage broker and kind of talk about their options because there's so much information you can find on the internet, but unfortunately it's not all that accurate. And I always tell people that you can really save yourself hours and hours of potential Google searches where you're not even coming up with the correct information by just having a 15-20 minute conversation with somebody that knows what they're doing to just kind of get started in the right direction. So I would say it makes a ton of sense to talk to a mortgage broker just to kind of lay out a game plan, right? Because I talk to so many people that think they need to save up hundreds of thousands of dollars to come up with a 20% down payment, because that's what their parents did. When in reality, there's so many other options out there. So if you have an idea of what you're doing, in the beginning, you can really set yourself up for success. So that's how I would start it off.
So after, let's say they speak to you about this, then would the pre-approval essentially be the second step people take in their real estate journey?
Pre-approval is really the first step, but I guess that initial meeting to kind of give you an idea, a little bit more of a roadmap, is important. And then once you kind of get to the point where you have the money and you're getting more serious, then the pre-approval is going to be, I guess, the first real official step. You got to figure out how much you qualify for, see if there's any kind of red flags, especially today, people do so many different things, and they think they can easily qualify for a loan, but maybe you just started your own company and you're not quite making money, you're writing things off. That's a big one we run into. People that may have maybe switched industries or may have gotten a large bonus and they think that's going to help them out, but if it's not something they've got a history of, then we're not going to be able to use it. So pre-approval is going to be super important just to make sure that you are financially where you need to be in order to qualify for a loan, and then also to just really make sure that you're in the right price range. You're going to be buying something that you can afford, that you're going to be comfortable with, and just really dialing in your finances before you dive into the real estate market.
You're right. This is essentially the biggest financial purchase decision that most people will make in their lives. So Frank, two questions for you. Number one, is there any scenarios where you would work with someone without a pre-approval? And the second question is, whether they have a pre-approval or not, and you decide to work with someone, what's the first step in working with an agent?
Yeah. So first question, you know what? I do, to be honest with you, because I'll have a conversation with the person, but where you really hit it off is what we real estate agents call belly to belly in real life, whatever you want to call it. So I will, depending on the situation, if there's a client I want to go after, I'll meet them in person, talk with them. It actually happens more often than not. I'm not going to probably show them 10 houses and work with them for a month or two before their pre-approval, but absolutely, I'll meet with them in person, talk with them, go meet them at the property, find out if they're pre-qualified, kind of what they're looking for in a property. And just to kind of add to Jason's thing, it's super important on that pre-approval to set correct expectations on, okay, this is what my down payment's going to be. This is what my monthly payment's going to be. this is what I qualify for. And then with that info, then we talk areas and where they want to live and amenities. So that's always super important. Assuming that they are qualified, then I like to have either, whether it's my initial consultation or the follow-up one is where I spend in person or on the phone with them. Yeah, and exactly. Now we know what you qualify for. Okay, well, what areas do you want to live in? Are we looking at condos? Are we looking at single family homes? Is a backyard important to you? Area, kind of find out what they're looking for. And even on that conversation, try to rein them in, because buyers have all these wants, but then what's actually like real out there that I'm seeing all the time, and kind of just have that conversation with them. But to set up that search for homes, because then I go on my multiple listing service, plug in those numbers, those areas, and look for the properties that they want and set up a list of properties, and send to them so they can pick the ones they want, and we can go see them in person.
I have to agree with you on the setting expectations piece, which is why it's taken me multiple years to pull the trigger, because I knew that there's a certain quality level I was looking for. I knew that there were certain areas I wanted to live in, and those two just never matched, until I realized for my special use case, instead of trying to bid, having to get into bidding war, which is kind of what has been happening a couple months ago for me. Just go like wait in line for like a new construction. So can either of you talk about that as an option, or just about like, actually take a step back, like what's going on in the market right now in Southern California? Is it bubble? Is it too high? Like, what's going on?
It's still definitely a seller's market. Low interest rates and low inventory have created that. We're in our typical, summer to fall market activity. All the kids go back to school, prices soften up a little bit, not as many people looking. I've been seeing some stuff now sitting for a little while, or even some price reductions, right, Che? On those higher priced properties that sellers are like, the last house in my neighborhood closed at 1.2. I want 1.25. And the buyers are like, it's probably 1.2 or maybe 1.210.
Yeah, I mean, I'm not, as deep in the actual fundamentals of the market as Frank. I'm on the finance side, so I see a lot of that stuff. But yeah, I mean, basically, I've seen what Frank's talking about, where each and every home that's been selling, it just seems like sellers are getting more and more and more and more. I mean, to the point where we're running into issues on the financing side, because when an appraiser goes out there to try to value this property, there's just no comps to pull in that value because it's going up so much. So I definitely see that. And to Frank's point, I have started seeing things maybe not go backwards, but definitely start to slow down a little bit, where sellers for a while were just throwing these outrageous prices out, and then they would get even more than that list price. Now I'm starting to finally see some things where it looks like maybe people are throwing out those outrageous prices, but they're not getting the action they want, so things are staying on the market a little bit longer, and maybe they'll even have to look at pulling prices back a little bit and a small price reduction to kind of finally get something under contract.
And that doesn't necessarily mean that prices are going down, but I mean, you can ask whatever you want for your house, right? It's only worth what somebody's going to pay. So if they're all selling in the neighborhood for $1 million, you offer, or you list your house for 1.1 and it sells for $1.025 million. Well, prices didn't go down. You still got 25,000 over like the last one. So some people hear buyers, oh man, I'm seeing the arrows pointing down, prices are going down. It's, well, they were asking the moon for the house. It didn't sell for that, but they still got more than the average comps in the neighborhood. So that's a little info there too.
Okay. I think before we get into like signing contracts, I do want to kind of discuss the cast of characters a bit, kind of just starting with you two. So Frank, question for you is, some people, they're not like, they've never used an agent. They don't understand, and they may have like a preconception of like a salesperson or trying to get you to do something you don't want to do. Can you explain who pays the agent in the state of California, and what are you incentivized to do, and what are you like legally bound to do?
Yeah, so the sellers pay the commissions. So the buyers, you're going to have your loan costs. There's some escrow title costs, but the sellers actually are the ones that pay for the commissions, which is nice when you're a buyer's agent. I'm sorry, when you're a buyer. So when you're a buyer, yeah, take advantage of this professional real estate agent that has a network, that knows how to negotiate, that can properly set up appointments and, get you in and out of houses, help you write the contract. the seller's paying for them, so use them.
Awesome. And then Jason, this is a more complicated one, which is, before I met you, I had no idea that there was such a profession as mortgage brokers. I just thought, since I'm a military veteran, I just thought USAA or, Wells Fargo. Can you explain to us why there are different types of what options do people have in terms of mortgages?
Quite a few options these days, and especially in this market, it's it can be really important who you're using, because contracts these days are they're so quick. Escrows are, transaction periods are shorter than they typically are, and the contingencies that go along with contracts are very, very quick. Then you layer on top of that the fact that a lot of places are hitting capacity because rates are so good and people are refinancing. So yeah, it definitely makes it not make or break, but it can be an important part of your process. So I guess if I was just to kind of quickly think about the different options, I would maybe break them down almost like three options. So one, you've got your traditional bank. That's what everybody kind of thinks about. And when you think about doing anything loan related, that's where the majority of people go. So your Bank of America's, Chase, Wells Fargo's, those types of places. That could work. The challenge there is, these have such a monopoly on the market that for the most part, interest rates at those places are typically going to be higher. The processing times are going to be a little bit slower and longer, and especially with the contingencies that I'm seeing come in on most contracts, it's definitely outside of some of these banks, realms of possibility. In addition to that, the type of loan options that you're going to be getting at these places, they're working banking schedules. So, they're in the office 8 a.m, they're out at 5 o'clock. And if you've got questions outside of those time frames, you're probably not going to get an answer until the following day. Also, banks are going to, really try to fit into the box. So they're going to have their guidelines that they want to set, and they're usually going to be a little bit more strict than other options out there. So especially if you kind of sit outside of the typical, straight salary W-2 employee, you might not fit into their box. So especially self-employed, we see tons of problems with self-employed clients that try to work with the bank, things like that. So your banks, that's kind of one option. Another option that I see that's different from me is kind of, I guess I would call it your refinance shops. So especially with rates being so low, there are, different companies out there that strictly specialize in, refinances, and they're set up to, just refinances only. And when they get something outside of the typical, again, the W-2 salary employee, they run into some issues on that. So that's kind of a second option. You're going to typically see, like when you hear of the lowest interest rates out there, I guess those are the different types of places I would think of, like a bettermortgage.com. They're going to get you a great interest rate, but you're probably never going to get an actual loan on a purchase with the types of contracts that are coming through. So that's kind of option two. And then I guess the third option is what I am, which is a mortgage broker. I like to think we're kind of the best of both worlds. We've got definitely by far the largest, catalog of products. So whether you're looking for a loan for that standard W-2 employee, whether you're self-employed, whether you're looking for a loan on an investment property, mortgage brokers are going to have the largest array of options there. And for the most part, I see that people that have been working in the industry longer and have a little bit more experience are tend to be on the mortgage broker side as opposed to some of the other options. So, I like to think you're going to get a much more kind of quality, product there. And I don't know, I guess we can hear what Frank says, but, for the most part, the brokers that I know, they're going to be a lot more accessible. So if you've got questions over the weekend when you're looking at putting an offer in with your agent, usually you're able to get a hold of that person and get the answers that you need instead of having to obviously wait until Monday morning to kind of get that stuff. But I don't know, Frank, what are your thoughts on that?
Yeah, no, agree. And I have clients like I'm not super pushy. I always ask, hey, do you have a loan officer you work with? If you do, great, get a loan approval from them. But if they don't, I always recommend chasing. It's not because he buys me lunch or takes me on vacation or anything. It's literally because he picks up his phone or texts you back after 5 or on a Sunday. Or, hey, we've made 7 offers and this one came up right now. We need to submit our offer. I need you to change the loan approval letter Saturday afternoon. Boom, done. Yeah, it's tough. Some of these banks, like Jason said, kind of 9 to 5. They deal with their work during their work time after that. And it's so tough when you're out there showing properties and busting your butt and making offers with the clients, and the loan officer is not on board. It makes it really tough. And I always tell people too, once you do get into contract, we're in a time period, when push comes to shove, you can't, if you're on a 12-day contingency period, you can't have your loan officer not answering calls till Monday. That will kill your deal. And you have your deposit on the line, like you could lose money. So that's super important. And it's what I always just say, when push comes to shove, you want somebody you can get a hold of because your money's on the line, period.
No, that's great. Let me summarize the kind of the steps I've heard so far. So step one is evaluate your financial position. Now, biggest financial purchase ever. A person who can help you is potentially like a mortgage broker or listening to our podcast. Step two is pick your team. Whether you want to use a bank, you want to use a mortgage broker, the three options Jason mentioned, as well as your agent, and then you go secure your pre-approval. Step three, it is working with your agent to kind of align on some expectations of what your pre-approval, your down payment, your financial position can kind of afford. And step four is essentially finding the property based on the parameters you agree to. Now let's get to like step five about making the offer, because you talked about contracts a bit. So one thing I don't really understand, Frank, is are offers binding? Because I hear stories of people doing things like, oh, I made like 12 offers. Like, what does that mean? How can you do that? And does it count?
I didn't hear that last part. Does it count?
Yeah, like, does it, like, if I make 12 offers, are they all binding?
Are you talking about 12 offers at once?
Yeah, I've heard of that before. People are just not making individual offers, but they're like, okay, I like this house, I like this house. I'll just throw out 12 offers.
Yeah. Well, it's not binding until the seller signs it. And you probably are going to get a counter offer. So the sellers usually aren't just going to take that. 12 offers at once is tough. A lot of times too, list agents don't want blind offers. So, I mean, if you've seen 12 properties, it sounds like what you're saying is you see 12 properties online that you like and you make 12 offers. It's probably going to be a waste of time, because those list agents are going to look on and, oh, you haven't even been to the property, like, throw it out. So, but yeah, I want to say three, maybe four max, where like we go out and we look at 10 houses over the weekend. They like 3 of them, especially in this market because it's just so competitive. Yeah, we do. We'll make 3 offers. Now, if you say you get 2 offers accepted, well, that's good news for your client. Go back. Hey, which one do you want? If you want this one, A, we'll go with A. I'll call the agent and cancel B.
Got it. So you could cancel an offer. That's
Yeah.
good to know. Otherwise, you're stuck with 2 houses. Would be weird. So Frank, I think you not only cover purchases, but have you listed properties as well?
Oh yeah, absolutely.
Great, because I want to hear about, because now we kind of know we've been talking about the buyer, but like the next step is really like accepting the seller accepting an offer. Can you tell us like the psychology or thinking behind what the seller or seller's agent thinks about? Because what I've heard is sometimes it's not just about like the dollar amount, right? It's about contingencies. It's about down payments. It's like all sorts of stuff involved. Can you tell us a little bit about the psychology behind all this?
Yeah, so it's going to be different with every seller, to be honest with you. Each seller is going to have different wants. Some sellers say, I'm only going to sell my house if I get this price. That's a little more difficult to work with. I do a lot of business with investors that buy homes, remodel, and resell. That's black and white. There's no emotions attached. It's a bottom line. They tend to be a little easier to work with. Their pros. This is what they do. They're not just, hey, I need to make $1 million on my house to sell it. But as far as like an offer, when you get an offer from the seller's point of view, more money down shows the buyer's stronger financial ability, shorter contingency periods. What's standard in the contract is you get basically 21 days to make up your mind whether you want to move forward with the house or not. If you can get those contingencies down, then that's more appealing to the seller, because the seller basically, when they accept an offer, the house now goes into backup status on the multiple, so it's off the market. So there are people that could potentially want to buy the house, but it's in backup, it's not on the market, so they pass. Then you get that buyer that potentially cancels. Well, now you've wasted 2 weeks of your seller's time. So those are some of the things that you look at: shorter escrow period, shorter contingency period, shit or get off the pot sooner is basically what it is. Money in the bank. I see some people that like to, if you have your house listed for $1 million and the person qualifies for 1.2 million, they change the loan approval to 1 million. In my opinion, I think that you should show the seller that you're more than qualified to buy the house. The seller can say, oh, I want one too. Well, the buyer's only going to pay what the buyer's going to pay. But like I said, there's some situations, like I had a property where I got 23 offers, right? So as I started going through them, the people, so I'll just throw out some quick numbers. We listed for 975. I was getting offers from 975 to 1,075,000. And the ones that were showing me loan approved, the lower ones, I had probably 5 or 6 at 975, and most of them had nine. To me, that was like, okay, that's the max they qualify for. I'm not even going to give them a counter, because I'm going to concentrate on the people that are from 1,025,000 to 1,075,000, because their loan approvals, guess what? They were at like 1.1, 1.25, 1.3, and why go back to this? We're obviously going to be coming up in price, so I didn't even counter those people. So see things like that as well.
So here's a myth. Maybe this is a myth, maybe it's not. Maybe you can help bust this myth. But let's say we're not talking about professional sellers. We're talking about like, mom and pop, like grandma and grandpa. And let's say it's a single family home in a neighborhood that in a community they've lived in many years. I've heard of stories where, between, kind of equal status buyers, the sellers can make like an emotional choice, like, oh, okay, I want that family because they're gonna raise their kids in this neighborhood, and I like this neighborhood, I like this community. I'm not just trying to get the best price. Is that actually is that just like a rumor, or does this like happen? Maybe it's like rare in reality that these things happen.
Yeah, no, good question. Most sellers, it's about price, money in their pocket, but I've seen it several times where, and I'm not even talking about where the buyer submits a letter. Maybe they met the seller at an open house. I had one. I walked in with the client, and it happened to be the husband and wife's junior high teacher. So we made an offer. I think the price was listed at 735. We wrote a 745 offer. Agent came back and said, hey, Frank, I really want to sell the house to Scott and Whitney, but there's a higher offer. If they can match this higher offer, I'll give it to them. And went back to him, said, hey, the place is yours. This is what you got to pay. Boom, they did it. I've seen that happen a lot. Jason, happened with Mark Shrey. There was a property for sale. It was an older couple. And it was like husband and wife, and they had their mother living with them. And then the reason that they sold the property, almost the same thing, had a higher offer by maybe $5,000, but same situation. It was like husband, wife moving in the house, and they were taking care of the mom. And just, they told a couple stories, had that connection, and they said, okay, if you can match that offer, it's yours. So I have seen it, not usually like in dramatic, like if I'm at, 750 and there's a higher offer at 8. I haven't seen even $50,000 taken over, but 5, 10,000 maybe. Usually like, hey, we like you. Will you match? Here's the inside info. This is where we want it. I have seen that.
And that's awesome. Look, we're not even up to the contract stage yet, and there's so much nuance, which is why I think it's super important to pick the right team. So let's talk about what happens after the seller accepts an offer. So we're at the contract stage. So what happens at the contract stage? And is this the point of time where we start to involve the loan officer again? We'll start with you, Frank.
Yeah, absolutely. So I get an email or a call from the agent. Hey, congratulations, your offer was accepted. So my first call is 99% of the time to the client. Hey, congratulations, we just got our offer accepted. So a couple things: you need to reach out to Chasen or your loan officer and start working with them. Two other important items are, generally you have 3 days to put your deposit in. So working with the client and escrow to get the wire information and get that taken care of. And then the third item is getting your inspection set up. In this market, like typical on the contract is 17 days for inspections. In this market, I mean, gosh, Jason, we've even had some at like 7 days, I think, where you have to get your inspections, get the whole house inspected within 7 days. You don't get 17, you get 7. So that's super important. So I make the call to my client, goes get those things squared away. Second call is to the loan officer. Hey, we got our offer accepted. They need the fully executed contract, which I have. I send that to them so they can start get working on them, and then make sure we're on the same page. Here's our loan contingencies. Here's our appraisal contingencies. They're shorter, so we got to work on that. And then after that, I get on the horn and start calling these inspectors and see when the quickest that they can get out there. That's what happens. When the offer is accepted, it's a lot of work right in the beginning. There's a lot of things going on. Your buyer's dealing with seller disclosures, escrow paperwork, and lender paperwork. So the first 7 to 10 days is a little hectic, but it's just part of it. You get in there, you get your hands dirty, you get that worked out. Once you get over the inspections and the appraisal, then it tends to just kind of smooth out, run its course, and then I'm getting a little ahead of myself here, but you sign loan docs and get the keys at the end.
So Jason, turning over to you. So what is the difference between a pre-approval and like a fully, I think you call it like underwritten loan? Can you explain that?
Yeah, so I mean, a pre-approval is just going to be, a loan officer or maybe like an underwriter sometimes just reviewing the income. But it's definitely not going to be typically as in-depth as like a fully underwritten approval. And so on that fully underwritten approval, which is basically once the property goes under contract, that's when all aspects of the transaction are going to be taken into place, right? So like on a pre-approval, I'm going to take a look at somebody's income, make sure that we're good there. It's not like we're not going to kind of, do our due diligence, but we're definitely not diving as deep, and we may take kind of shortcuts to get where we need to be. So, for instance, if somebody just say has, bonus income over the past 2 years, normally I'm going to need a full verification of employment from their employer. Well, that might cost money to get. And so, in lieu of that, we'll use, hey, give me the last your year-end pay stubs for, 2019 and 2020, because that's going to have the same information on it. So yeah, I mean, a fully underwritten pre-approval is just going to be a lot more in depth, and it's going to take into account other facets of the transaction. So, we'll start looking at the property, whereas before we didn't even have a property, right? We're going to start looking at the property. We're just going to dive into everything in a little bit more depth.
Great. So let's say, you do all your due diligence, you get the fully underwritten loan. What's the next steps after that, Frank?
So once you go into contract, the two biggest things that you got to overcome are the appraisal. Obviously, the house got appraised, so that's huge. And then in other states, they do the transactions a little differently, but in California, we I guess we kind of put the cart before the horse. You go, like, to back it up a little bit, you as the buyer, you look at a house, maybe you see it twice, right, for 15 or 20 minutes, maybe 30 minutes at a time. You write your offer, you go into contract, then you get the house inspected. Then you actually find out, oh, the roof is leaking or there's plumbing issues. So then you got to negotiate repairs. And they can come in a form of, hey, seller, we want you to give us a credit so we can fix it, or hey, seller, we want you to put the new roof on it. So once you go into contract, you get the inspections done, you got to make sure the appraisal comes in, and then negotiate any repairs or fixes at the property. And hey, depending in this market, a lot of times the sellers are telling buyers, hey, we're not doing anything because there's 10 people standing in line. So if you don't like it, tough, but you need to, from the buyer's perspective, you still need to get the property inspected, because even if you buy it as is, you still need to know what you're buying, because, and whether the seller fixes it or you fix it, you need to know what you're doing. So once you're in contract, that usually happens at about day 14, 2 weeks in, get the appraisal in, negotiate any repairs. After that, it kind of just goes into kind of smooth sailing. Jason just kind of, I don't know, rides us into the sunset, gets those loan docs and pushes the button, funds the deal.
Yeah, I mean, it sounds good like that. I guess it's definitely a different transaction on my end. So like Frank said, as soon as the property goes under contract and the client's got that property, everything speeds up. So especially with the contracts that are written these days, like Frank mentioned, the contingencies are extremely low. So like, an inspection might normally be 21 days. Like he said, we've had them as low as like 7. I see 10 days all the time. Appraisal contingencies, for the most part, I would say most of the offers, that I see coming across right now, or most of the contracts, don't even have an appraisal contingency in it. So, if that appraisal comes in low, you're stuck paying the difference. And then the loan contingency is much shorter as well. So on my end, as soon as that client goes under contract, it's basically a rush to get everything done. So we've got to get that loan started, and it's really difficult because there's a lot of different, parties of the transaction, and it all kind of has this kind of waterfall cascading effect where, I can't even start my loan until I can disclose the terms of the loan and the costs of the loan to the client. But the challenge is I can't disclose those costs until the escrow team and the title team send me what the costs are going to be on their end. So, you can get into a situation where somebody goes under contract and it takes the escrow team a couple days to get those fees over to me. Meanwhile, the clock is ticking. Like Frank said, we're on the clock at that point. So the time is ticking. We can't even disclose that loan. That puts the appraisal. I can't order the appraisal until I disclose the loan and the client sees it and signs it. So there's just all this stuff that happens right at the beginning. So it is extremely hectic, but assuming we get all that stuff handled, yeah, we're going to go ahead. We're going to get that loan approved. And for the most part, what's been happening these days is we'll have that loan approved, weeks before the transaction's ready to close. And then as soon as I've got that, basically that file all cleared, that's when I'm making a call to Frank to say, hey, I know we're not supposed to close for another 2 weeks, but we're ready to go. Do we want to close this thing early? Is that a possibility? And then he'll go and negotiate that with the with the seller and see if they want to wrap it up ahead of time.
So the beginning is a little hectic, but that's why you want to work with somebody with experience that's seen the movie 300 or 400 times, and a loan officer that's done hundreds and hundreds of transactions. Because not going to lie, it is hectic, but it can be navigated correctly and not be stressful if you know what you're doing.
Okay, so final question, because you mentioned appraisal a couple times. I want to understand what happens in these two scenarios and which scenario is more common. So let's say the price is $1 million, and let's say the appraisal is $950,000. Why does that matter? What happens?
So the lender is only going to make their loan off of the lower of the appraisal or the contract price. So if we're in contract at $1 million, it appraises for $950, the lender is going to, all the numbers from the lender's point of view are going to be based off of $950. So generally the way it goes is the buyer goes to the seller and says, hey, drop the price to $950. Seller says, take a hike. I've seen sellers say, okay. I've seen sellers, how about we meet in the middle? You come up 25, we'll come down 25. In this market right here, right now, it's usually sellers like, hey, do you want it or not? Because I have 10 people that are standing in line. I know I said that line earlier, but that's how it is. So like Jason mentioned, a lot of times up front, whether the buyer puts it in their offer or the seller gives you a counter, they counter the appraisal contingency out. So that doesn't necessarily mean if the house appraises for $950, you have to buy it for $950. You could potentially the buyer could still potentially cancel for inspections or for loan, but you're basically upfront saying, I'm not going to haggle a low appraisal with you. If it comes in lower, then I'll pay that, even though you can still cancel for other things. Versus if there is an appraisal contingency, then you can start haggling with the seller.
So, as a buyer, you pay taxes based on the appraised value.
No, the purchase price.
Oh, okay. So you're kind of okay. So you get kind of screwed both ways. Not only do you have to pay a higher price, now you have to pay property taxes on a higher rate as well.
Yeah.
Okay. Now
the appraisal is part of the transaction, but the purchase price, what you pay for the property is what's going to be recorded with the county.
So so that's one scenario. This scenario sounds more uncommon, but what happens if the appraisal is above the purchase price? Like, is that even possible? And what happens?
Yeah, absolutely. It's more beneficial for the buyer. The seller, so the buyer pays for the appraisal. Appraisal comes into the buyer's lender. It's the buyer's appraisal, right? So if the appraisal comes in less, you go to the seller and say, hey, I want you to drop the price. Well, let me see the appraisal, right? If the house comes in higher, seller doesn't even know. It's a little gravy in the pocket for the buyer.
Nice.
Yep.
No, that's awesome. I think, as you guys said, this is all done. You get the keys. Any other parting words? Just like kind of like high level suggestions or thoughts? Because in the future episodes, we're gonna get into more details. But this is just like episode one, just like the high level.
In real estate, like experience is everything. So go with somebody that knows what they're doing. The money's on the line.
Yes, it is a lot of money. Jason, any final words from you?
Yeah, I mean, just like Frank said, experience is key. So make sure you've got a good team, and try to plan it out in advance as much as possible. I can't tell you how many clients I get that we'll talk about a pre-approval and they'll say, "Oh yeah, I'm going to send you all my stuff," and then I never hear from them again. And then a couple months later, they'll say, "Hey, good news! I just put a property under contract. What do we do now?" So just take your time up front. Make sure you get everything kind of dialed in. It's going to make the process so much easier and smoother. And really, I mean, these are huge transactions. For the most part, it's the largest financial transaction that most folks are going to make in their entire lives. Typically in that transaction, something is going to go not according to plan. So if you've got a good team and if you did your research up front, it's you're going to keep the train on the tracks. Whereas in the opposite, if you don't have a great team, if you don't have a plan in place, man, it can sure get stressful, and you don't want to go into your new home with all these bad feelings because you just feel like you lost money or you got rushed into something or you just didn't get what you thought you were getting. So take your time, get a good team, and in the end, it should be a pretty smooth process.
Awesome. Well, thanks, guys.